Stop scrolling. This is a silver alert. China's physical silver market just ripped past $128 per ounce. U.S. futures still sitting near $100. That's a 16 soles to $8 premium overnight. And it's not closing, it's widening. When physical markets price metal this far above futures, the message isn't about price predictions. It's about availability. If you're holding silver, watching silver, stacking silver, or trading anything tied to industrial metals, you need this context now. If you're watching this video in the first 24 hours, you're ahead of the crowd that waits for headlines. Your job isn't to predict where silver goes. Your job is to understand what these signals mean before the structure shifts. I'm going to teach you repeatable patterns, not predictions, patterns. The most important signal isn't the price, and I won't name it yet. Quick ask, if you're serious about understanding markets instead of just reacting to them, hit subscribe. We watch what others ignore. Here's what happened. Shanghai silver premiums exploded to $16.8 over futures, while Comex inventories dropped nearly 1 million ounces in a single day. Multiple warehouse facilities reporting outflows. Registered inventory, the metal actually available for delivery, draining fast. Futures markets are saying liquid and stable. Physical markets are saying rationing through price. That's not noise, that's structure. And here's the hidden layer most people miss. Premiums are prices too. They're just quieter. When premiums spike, physical buyers are screaming, "I can't get metal at your paper price." This is where most people get trapped, watching price charts while missing the availability signals underneath. Let me name what you're watching. It's called Paper-Physical Decoupling, simple version. Futures markets operate on leverage and liquidity. Physical markets operate on actual metal and delivery. When those two worlds price the same asset differently, one of them is lying. Think of it like a pressure valve. Futures absorb stress, speculation, hedging, position rolling through financial settlement. As long as most traders close positions for cash, the system works. But physical markets don't have that release valve. When someone wants metal delivered, either you have it or you don't. Right now, the valve is stuck. Shanghai buyers are paying $128 because they can't get metal at $111. That premium is the market screaming scarcity. But futures traders are still trading like inventory is abundant because their screens show open interest and they can exit positions with a click. This pattern repeats because financial markets optimize for leverage and physical markets optimize for survival. I've watched this play out in palladium in 2020, rhodium in 2021, nickel in 2022 before the London Metal Exchange chaos. The mechanics are always the same. Paper claims pile up faster than physical supply, premiums widen, and then something forces reconciliation. Not telling you what to buy, showing you what decoupling looks like before it resolves. Here's why it matters this week. Comex registered silver inventory dropped from roughly 67 million ounces to around 66 million in 48 hours. That's not catastrophic yet. But watch the pace. Inventory drawdowns don't move linearly. They accelerate. Shanghai premiums at $16–18 are historically extreme. Normal premiums run $0.50 to $2. Even during tight conditions, $5 to $8 is stressed. We're at double that. And industrial buyers, solar manufacturers, electronics producers, can't wait for prices to normalize. They need metal to keep production lines running. When they start paying premiums, it's not speculation, it's survival. Circle this. Financial traders can walk away from contracts. Industrial users can't walk away from factories. That asymmetry is the trap. Now, layer in inventory psychology. Warehouses don't signal danger until behavior changes. You can watch inventory numbers drop for weeks and assume it's normal drawdown. Business as usual. Then one afternoon, a major withdrawal hits, then another. Then smaller players rush to pull metal before it's gone. Confidence doesn't crack linearly, it snaps. Imagine you're a bullion bank with 500,000 ounces of client obligations and 450,000 ounces of physical inventory. On paper, you're close. In reality, if 400,000 ounces suddenly request delivery, you're scrambling. And if word gets out that you're scrambling, the remaining 100,000 ounces panic. That's not default, that's hesitation. And hesitation spreads faster than defaults. We saw this with nickel on the LME in March 2022. Prices were volatile but manageable until they weren't. A massive short squeeze combined with delivery stress forced the exchange to halt trading and cancel trades. Billions in losses, years of lawsuits. Silver isn't nickel. The market structure is different, but the psychology is identical. When claims exceed metal and someone blinks, everyone moves at once. Right now, Comex open interest sits around 140,000 contracts. Each contract represents 5,000 ounces. That's 700 million ounces of claims. Registered inventory available for delivery, around 66 million ounces. Do the math. That's roughly 10-to-1 leverage. Not every contract demands delivery. Most settle financially. But if even 10% of longs stand for delivery, that's 70 million ounces against 66 million available. The system works until it doesn't. Think about that. This is the moment before confidence flips. Here's what you need to sit with. The real question isn't, will silver go up? The question is, who gets metal when they ask for it? If you're a bullion bank that sold futures naked, expecting to settle in cash, what happens when counterparties demand physical? If you're an industrial buyer who locked in prices months ago through contracts, what happens when your supplier can't source metal? If you're holding physical silver in your own possession, what happens when paper claims far exceed available inventory and the crowd realizes it? I'm not predicting which path this takes. I'm showing you the pressure points, and I'm not resolving this yet. You need to understand the scenarios first. Let's walk through what could happen, not predictions, possibilities. Path 1 is normalization. Shanghai premiums compress back toward $2 to $5. Comex inventories stabilize or tick higher as metal flows back into warehouses. Futures and physical converge. The decoupling was temporary stress, not structural break. Who benefits? Anyone who stayed calm and didn't chase premiums. Traders who sold volatility. Shorts who covered early. Who scrambles? No one. The system resets quietly. Path 2 is grinding stress. Premiums hold at $12 to $18 for weeks. Inventories leak slowly, not catastrophically. Industrial buyers absorb higher costs and pass them downstream. Financial traders keep rolling contracts, avoiding delivery. The decoupling persists but doesn't explode. Who benefits? Physical holders, patient accumulators. Anyone buying at spot instead of premiums. Who scrambles? Leveraged longs who expected quick resolution. Industrial users with thin margins. Path 3 is shock, a sudden 2 to 5 million ounce withdrawal in a single week. Delivery notices spike. A major dealer or bank flags, force majeure or settlement delays. Premiums rip to $25 to $40. Futures spike or get halted. Headline risk floods in. Who benefits? Anyone holding physical before the break. Option buyers, volatility traders. Who scrambles? Everyone who trusted paper claims without exit plans. Could reverse at any point. Could normalize tomorrow. But the structure right now is stressed, and stress compounds until it releases. Not advice, pattern recognition. Here's what I'm tracking this week. First signal. Shanghai silver premiums. Normal is $0.50 to $2. Stressed is $5 to $10. Critical is $50 and above. If premiums compress below $10, the pressure is releasing. If they hold or widen past $20, physical scarcity is intensifying. Watch daily. Don't wait for headlines. Second signal, Comex registered inventory changes. Normal is fluctuations of 100,000, 300,000 ounces daily. Stressed is single-day withdrawals exceeding 500,000 ounces. Critical is multi-day drawdowns totaling 3 to 5 million. If inventory stabilizes or ticks higher, confidence is holding. If withdrawals accelerate, behavior is shifting. Third signal, backwardation and near-month tightness. Normal is futures curve in contango, later months priced higher. Stressed is when the curve flattens. Critical is when near months trade above distant months. Backwardation signals immediate demand, exceeding future supply expectations. It's a quiet warning before headlines scream. Fourth signal, delivery notices versus open interest. Normal is 2 to 5% of open interest stands for delivery. Stressed is 8 to 12%. Critical is 15% and above. If delivery intentions spike, Someone wants metal, not cash settlement. That's behavior change. Fifth signal, industrial demand headlines. Watch for supply chain stress in solar, electronics, EV components. Not investor hype, production constraints. If manufacturers start flagging silver sourcing issues, that's demand you can't defer. Financial speculation is optional. Factory inputs aren't. Can't know timing. Only structure. If you're a short-term trader, respect volatility. Position size accordingly. Stops matter more than usual. Don't overstay leverage in dislocated markets. If you're a long-term holder, accept that pullbacks and whipsaws happen even in stressed structures. Physical possession gives you patience. Use it. Risk cluster I'm running. Time diversification. Not all in at once. Information diversification. Watching multiple signals, not just price. Position sizing. Small enough to survive being wrong. Optionality. Keeping dry powder for scenario 3. Patience. Letting structure resolve instead of forcing trades. Your approach might differ. That's fine. Just know what you own and why you own it. Here's the bottom line. If you're watching inventory drawdowns, premium dislocations, and delivery stress instead of just price charts, you're in the group that doesn't panic late. You're in the group that understands structure before it breaks. And you're in the group that knows the difference between paper claims and physical metal. Markets don't warn loudly. They whisper through premiums, through inventory changes, through backwardation. The crowd hears the whispers too late, after the headline, after the move, after the scramble. You're hearing them now. Drop a comment. Are you watching physical markets or paper markets? And if you've tried sourcing physical silver recently, coins, bars, industrial quantity, share what you're seeing. Delays, premiums, limits. That ground level intel matters. If this breakdown helped you see the structure instead of just the price, hit subscribe. We're building a group that watches what others miss. And if you've been in markets long enough to see a decoupling resolve, bullion, commodities, anything, drop your story below. What broke? What held? What did you learn? Final thought. Price tells you what happened. Structure tells you what's happening. Behavior tells you what's coming. You just learned to watch all three. Stay sharp.